Hello there. In this video, we'll look at translating the cost, volume, profit, and break-even related concepts to situations that are more reflective of real world where companies sell more than one product, or multi-product CVP. This corresponds to Learning Objective 3.6 in your text. The example in your text is based on two products. We have product Do All, which we'll call DA, and Superword, which we'll call SW. The break-even formulas and all of the other formulas, whether we're using a target operating income or target net income, are going to be all the same in that we would divide by a unit contribution margin or contribution margin ratio. But in this case, with multi-products, we need to develop what we call a weighted average contribution or contribution margin per bundle. So imagine this situation where we sell a bundle of product, so a box of product, and in that box there are 3 packages of DA and 2 packages of SW, and that makes up a bundle. Now each product has its own contribution margin. So for Do All, the contribution margin per unit is $80. So what we do to help establish a weighted average contribution margin or contribution margin per bundle is simply take the sales volume or the mix. So what we have here is a mix in essence of 3 to 2, where we have 3 Do All to 2 Superword. So we take 3 units of Do All in a bundle and we multiply that by the unit contribution margin for 1 unit of Do All, and that gives us $240. We then take the 2 units in a bundle of Superword, multiply by its contribution margin of $30 to give us $60, and then we add those up to get a total contribution margin per bundle. And then the rest is essentially the same, where if we wanted to calculate the break-even instead of units, but the key here is it's the break-even number of bundles, not individual units. The formula would be the same. We would take the fixed cost, but instead of dividing by the unit contribution margin, we can call this, in essence, a bundle contribution margin, or a BCM. So if we take fixed cost divided by the bundle contribution margin, based on the problem that's in the text, we have a $4,500 fixed cost. The contribution margin is $300 per bundle, and that's 15 bundles. Well, we're not quite finished. That's basically 15 total boxes of product that each contain 3 units of Do All and 2 units of Superword. So what we have to do, essentially, is make sure that we multiply by 3 units of DA to give us 45 units of DA, and we multiply by 2 to get 30 units of Superword. That's exactly what's going on down here, okay, except in a more visual format. And then if we know that the selling prices are $200 and $100 respectively, so we would multiply this by the $200 unit selling price to give us $9,000 in total revenue for Do All, and times $100 for unit selling price to give us $3,000 for total revenue required of Superword. That'll give us a total of $12,000 in total break-even revenue that consists of $9,000 of Do All and $3,000 of Superword based on 45 and 30 units respectively. So that's the foundation for adapting the basic CVP fundamentals of a single product to a multi-product scenario.